Okay, everybody, welcome back to Trading Corner. We postponed last week's episode because we were eagerly awaiting what was going to happen in the Middle East. Something happened. It was a bit of a disappointment for the bulls. But I guess the big question now is, has this conflagration between Israel and Iran played out? Is it over, or is there going to be kind of like a second flare-up possibly before the election date on Tuesday? I think at current price levels and given the geopolitical backdrop that there's a pretty exciting, kind of long, tactically long flat price trade setting up. Also, I think options have really repriced lower on the back of détente or perceived disappointment in terms of, lack of kinetic warfare out there. So I think that the market is now overly complacent, and I think that the risk reward looks great to the upside and from the long side if you're looking at options.
Yeah, so this weekend, I guess the market was kind of sitting and waiting, similar to us, to see how the retaliation would go, right? And
Yeah.
with any kind of anticipation, once the event happens, as we saw with this weekend, actually more often than not, it doesn't lead to the market moving the way that you would expect, but actually now the market can be sure that it's done.
Yeah.
And so the sell-off wasn't that surprising.
Yeah, that made sense.
That totally made sense. Whether there'll be any escalation from here, I mean, who knows? But as you said, yeah, we have the election coming up. We have a couple of holidays, of Thanksgiving.
Yeah.
Middle East, I mean, who knows? Hopefully this is the end of it now. So it kind of feels like it was right, as we came in on Monday, that the market had calmed down.
Yeah, $4 of geopolitical risk premium coming out. But now we're back to the lows. The market's maxed short.
Yeah.
The geopolitical risk isn't really gone. They're, talking hawkish about responses, both Iran and Israel are. The election's coming up, and the fundamentals for 2025, the balances, they don't look as crappy as the
No.
market is pricing right now.
Exactly. So we've had, throughout October, really, we've had this nice uptrend in the margins, and products are really leading the market. I mean, gas oil in particular, the strength is really there.
Yep.
A lot of this is also coming out of the east as well. So
We called the gas oil trade on this podcast, by the way. For the
we
record.
did. But, the concern around China and whether the eastern countries are really going to start pulling products, etc. It feels like that actually the last couple of weeks that buying has come back in, which is really helping the margins. So it does seem as though we've definitely had rebalancing in the products. We've also now gone and, we're past the turnarounds in the refiners in Europe especially. And given that we're producing more product and the margins are holding, the cracks are performing, it's quite a good sign for the market, right?
Yeah, and if you get a cold winter, that product demand could persist or even outperform. I think that, so question, are the refiners active with you right now? Are they in there buying, selling, doing nothing?
So crude's kind of a slightly different space. I mean, the last time we spoke, I said that the market was quite aggressively selling and you just kind of wanted to sit back and wait for that to be done, which we did have. So at the start of this week, we had a bit more buying appetite in the physical cargoes, particularly TI Midland, but also some of the local grades. I think Brent's traded and 40s is traded. So we are slowly getting that physical demand come back in. And the people that are transacting, a couple of trade houses, but also refiners. So you can see that there is a bit more healthy demand, but
They're not selling is the point.
they're not selling, but the diffs are still pretty low.
Yeah.
So versus where we see the margins to be, I would expect these diffs to pick up,
Yeah.
which we've had a decent kind of 30 to 40 cent rally, but for dated, that's not very much,
No, not at all.
to be honest.
Does it feel like your participant base is short? Like, to me, this seems like a perfect time North Sea-wise for a play, right? You have specs max short, prices at the lows, spreads near the lows of the year, geopolitical risk, I would argue, still near the highs of the year. Like, this isn't over, right? And like the fundamentals aren't deteriorating rapidly into some sort of black hole, right? Quite the opposite, I would argue, to all the points you just made. Fundamentals, physical diffs, margins, they all seem like the next move is either stable to upwards rather than downwards. So with a fundamental tailwind, the market max short, and that geopolitical kicker, that's a perfect time for somebody to come in and just
it's definitely
make
a good
a
argument.
statement.
It's definitely a good argument. And to be honest, for me, I love playing long. So
Same.
if I had the chance to, I for sure would. Even if all the ducks weren't in a row, my bet on being long is probably 80 to 20, to be honest. But I have been long for the last kind of 2 weeks, and we have rallied, but it's not been anything that's getting the market excited. I feel like it's been a real struggle to push your long position, even though the price action's kind of been in your favor. So it's been fine, but it's been nothing like the bull runs we've had.
Well, we had that.
The last few years.
I guess over the last 2 weeks, you also had the geopolitical risk premium come out.
Yeah.
So that was probably an annoying day to be long. But like from here now, with all of the new information, I think it's a great time to be long. You're gonna get a play probably. Like there's already rumblings about one party out there. You were saying buying everything up, and then the other thing is, like again, I guess I sound like a broken record at this point, but. If the missiles start flying again, which I would put at 50 to 70% probability, I don't think this is over. Basically what Israel did was they took out a bunch of air defense batteries.
Yeah.
That in isolation seems like a strange move. You would do that in order to set up another attack, wouldn't you? I don't know. I'm not a geopolitical expert.
Well, I guess it's also, I'm sure they've had a lot of pressure from the US government saying
to
do not
stop.
Yeah, and if you're going to do anything, try and minimize the damage as much as possible, which arguably Iran played it down, saying, that there's been no kind of big structural damages, but can you say a strike is fairly
limited? Yeah, no, it was a limited strike. I totally agree with you. I just thinking from first principles, from a purely Machiavellian perspective. This is why I think the geopolitical risk is high, and I'm not an expert on this, but let me just take a stab at it. If you're Israel and you feel happier, more supported under 4 years of a Trump administration than a Biden administration or a Democratic Kamala Biden administration, you've taken out Iran's ability to prevent you from attacking.
Yeah.
And war in the Middle East is good for Trump, bad for Democrats. They could really just go and give, sort of have one last go at it before Tuesday.
Yeah.
Now, I wouldn't want to bet on that if prices were in the middle of the range, or definitely not if they were on the high end of the range. We're close to the lows of the year. This feels like a good yo, right?
For sure. Geopolitically, I totally get you, but then you also have to look at this backdrop of OPEC.
Yeah.
Right? They came out yesterday again saying they could deter the production increases for another month. Are they going to keep kicking the can down the road? But the market's very aware that we have this oil production which is ready to hit the market.
Yeah.
And so if we look at the crude space, it's a bit difficult to get. I don't know.
Yeah, I don't think you're bearish
for.
You're not bearish for a move to $100, right?
No, but
sorry, bullish for a move to $100.
Yeah.
You're bullish for a move from 70 to 80.
Yeah.
Or 72 to 82.
Yeah, which
because there's like short squeeze potential here. It's like a positioning unwind that you could get ahead of.
But given given the flat price profile, exactly $10 for something that's going to, quite frankly, take up a lot of VAR, is very capital intensive, and the downside could equally be $7 before we get to $80. So is that really the best risk to reward trade?
You think we could go to $65?
I think we haven't flushed yet.
I guess that's where I disagree with you. Respectfully, of course, we easily could, right? I just think 65 or low 60s, like that price set was on the table a month or two ago when fundamentals looked like absolute trash. And 2025 balances looked like absolute trash. Everything's been revised better since then. I don't think that's on the table anymore.
Yeah.
I think OPEC is jawboning like they're going to attempt to defend the market. Because they basically, with OPEC, since you brought it up, it's binary. Either they go full market share war, or they just do their best and throw good money after bad to keep prices where they are. I think they choose the latter in the absence of some absolute deterioration, like COVID-style deterioration in fundamentals, which isn't happening.
No,
and
I
then
agree.
On the other side of the equation, we could go to $65 just on a momentum trade if it weren't for the fact, again, I keep sounding like a broken record, if it weren't for the fact that specs were near record short. There's a lot of financial paper buying to be done on every dollar downdraft, especially at this point in the year when that spec community that's max short wants to take some profit, lock it in. bring it home, buy a new house, buy a new car, that kind of thing. So
I do totally agree, but from my perspective, at the very least, as I was saying, the risk reward for me is not being in long flat price. For me, it's being long these differentials
yeah.
and long the contracts which
Which
have,
differential in particular?
so long contracts which have way more of an exposure to physical strength than we do to speculative money or to, because truly, I mean, what really is flat price? We said in the last podcast, you know, I personally wouldn't have been surprised if we could sell down around $5 to $6 and have no change in the Brent spreads.
Yeah.
Because we're constantly in a position of, you know, there's too much premium or not, or too much discount into flat price. And what does it truly mean? Whereas at least these physical differentials, relative to a benchmark, they have true meaning.
Yeah.
You know, what premium or discount are you willing to pay for this physical cargo, rather than a kind of flat price level? I mean, for me,
Maybe spreads is the trade. Maybe like month, I guess, Jan, Feb at whatever it is, plus 35 cents backward, around there, roughly. Maybe that's a good buy. Because ultimately, like, most paper traders can't go and buy WAF diffs, right?
Yeah.
But the WAF traders will at the physical shops. And then when the WAF traders buy their diffs, all the med traders and the other sort of
the knock-on effects.
all these other traders are going to buy their diffs, and that'll filter through to the North Sea market. Your market will rally, then spreads will rally. Like, it's all connected.
Exactly,
So.
it's a true ecosystem. Whereas you look at flat price, and my opinion, you know, my opinion only, but there's just so much noise in it that we could easily sell down to 65 and bounce back up to 80. And fundamentally, physically, balance-wise, etc., nothing needs to have changed. For me, it's a bit binary within this like $10 to $15 range. You know, so if we get all the way down through like $60, maybe $50, it might look different. And equally to the upside, $90, $100, you have to expect the physical markets will truly move.
All right, so let's say Israel takes out like Fordo or Natanz, like big nuclear facilities, and maybe they hit some Iranian oil refinery. Maybe they don't go for Karg Island, but maybe they go for like a inland refinery or something. I would say flat price is trading $82 like overnight on that, maybe 85. Where do you think Jan Feb Brent spreads are? A buck backward? More?
Probably. Again, it depends on what the physical picture is saying. In this current state,
Just knee jerk, like.
I'd expect at least 75 cents, yeah.
Yeah, okay.
And that's not ridiculous.
But if
for
we
a
go
Brent
down to
spread.
$65 flat price on inertia, like, we're probably not going into contango in
No.
Jan Feb Brent. So that's the better risk reward.
Which is why I think it's a great place to put your VAR if you wanted to be long in contracts such as CFLs, Brent spreads, etc. I think flat price is done. Like, it's been so boring this year.
So boring.
And
Spread's been pretty boring too, to be fair.
Yeah, but it's just,
But not as boring as flat price.
you can have more conviction in the Brent spreads, and ultimately you can probably defend them a little bit more as well than flat
And the
price.
downside is capped, whereas with flat price, who knows? So I take your point. I think that's very fair.
Yeah.
Options are interesting too. Like, just very briefly, the implied daily move went from like, $2.50 to $2.50, $3. I guess there's options extra in the middle of that, so it doesn't really count. But like, let's call it $2.50 a day break evens before this, like when everyone was waiting for this attack, and now it's down to like 140, which is a big move in that sort of prompt break even space. Realized volatility is like 150, 160 above implied. Now, obviously, that includes some big days that like that $4 down day that aren't going to happen again, probably. But I still think that these are decent levels to get long straddles.
Yeah, I mean, I guess those contracts, they provided the market some insurance. That's exactly what they were used for, and it allowed the market probably to get potentially short structure or, physical contracts, whatever, against this looming Middle Eastern tension. So yeah, I mean, I'm not too surprised that it's come off yet, but it'll be interesting to see how that space moves for sure.
Definitely.
And we had exactly the same with freight. Freight rallied, all this Middle Eastern tension, and now it's kind of starting to soften again. So that might help open up some arb flows because they've been, quite shut the last kind of month or so. So yeah, we're definitely going into a space where we might potentially see a bit more physical activity. I think, a couple of trade houses have closed their 2024 year, so they might get a bit more encouraged
aggressive,
to start positioning in something. But it's definitely the product market that looks like it's really, catching some wind at the minute.
Interestingly enough, the indicators that I've fought, like gas oil has been my favorite trade for the last month and a half. The indicators that I look at to trade that market are finally starting to soften. So
Okay.
maybe
Yeah.
diesel, gas oil has had its starting to maybe that the momentum is starting to tail off there.
Okay.
Just from my limited
Yeah.
perspective.
To be honest, even the margins versus the crude diffs seem a bit overexpensive
Yeah.
here. So either we need to get crude to pick up or the products to soften just to balance.
Which products do you like here? Which product trades, if any?
I think going into a colder season, being long in the middle of the barrel will just provide a bit of protection. But going into January, or December and January especially, I think we are going to get quite cold, which is going to mean some problems for refiners as well. So I think there should be a bit of premium in, to be honest, all of the product spreads, or crack rolls, whatever it is. Because it's been quite mild still. Like we're hitting November, and yeah, I don't think we're anywhere close to how cold it was last year.
Yeah.
But no, I do think the margins will probably potentially soften a little bit, and it is holding everything up at the minute. So let's see. I think the confidence we're getting out of the East is great for the market. So I'll keep an eye there. Look at all the East-Wests. Brent to buy is quite interesting. That's performed very well recently.
Yes.
I think we're getting a bit of a flush in the Dubai spreads. The market's selling out of a bit. Again, might be due to the Israel-Iran, or perhaps the bull play in Dubai is finally done. I think it's been a good 6 months of it. So
Yeah.
it might look that we're flipping back short there. But even those flies in the front, I think we've got like a dollar on the positive dollar on the front flies, which is pretty massive.
The Dubai market's hard to be short as well. It's just like whenever there's an OPEC cut, that whole community likes to trade it from the long side.
Yeah.
It's easier to squeeze.
Exactly. So it might be they're just pricing in.
And they all have information too. Like all of the trading houses are in bed with ADNOC, and they know exactly when. There's going to be a surge of flow versus when there's going to be a deficit. They're all talking to the refiners in the East. It's like
it's a small market.
Yeah, I mean, a lot of people live there, but it's like the oil flows it's kind of a niche.
Yeah.
And the community that trades it is like also a niche, and they
that's
tend
what I
to
mean.
trade
Exactly.
well.
Exactly. So just lastly, looking at WAF diffs,
Yes.
we like to look at it as a bit of a forward indicator. The OSPs for Nigerian crude just came out, and they're much lower, back down to kind of July levels. So also looking at that, maybe they're just dropping because we've got TI starting to settle, so they have to start competing with those cargoes. But right now for me, I am long. I like being long. But my worries are
Same.
those OSPs are a bit lower, the threat of OPEC. And if we do start getting freight soften a bit, it could be that a lot more TI starts landing. So again, we're in a very dynamic market. Who knows, tomorrow I might be saying the absolute opposite, but I'm tentatively bullish.
I'm tentatively bullish as well, positioned tentatively bullish, although I think the risk reward is looking better and better by the day, and like for a week, and then after that, who knows. As far as like WAF diffs and Nigerian OSPs, the way I used to look at it was that the Nigerian OSP was kind of a random number generator, unlike Saudi OSPs, which are actually like quite correlated with performance of Brent spreads over a trailing 3-month period,
there's a very
2-month
set
period, and then they would like
formula.
set them above or below like the model output to try and like juice flow to one region and reduce it to another based on their sort of internal decision making.
Yeah.
Nigerian OSPs, like I don't think in the past when I looked at it, I don't think they ever really employed that level of discipline or sort of systematic structure to it. So I never really paid attention to it. Now it may be more relevant or less relevant with Dangote ramped up. I don't know. Like I no longer understand that system.
Yeah, it's still a good. It's good to keep an eye on it. But no, exactly. For the Dubai ones, they set the OSPs retroactively.
Okay.
So they have a set formula.
Yes.
So very transparent. You can kind of estimate it.
Saudi similar, even though it's less transparent. But.
Yeah. But yeah, Nigerian OSPs, I mean, I haven't
That's
seen
an interesting
any
idea,
data
though.
on it.
I'll have to go research that.
Yeah.
Sounds good. It was great talking to you.
And you.
Thanks again.